Lapis here with Remax Hallmark here in Toronto, and I'm back this week with another market update. And this week I want to talk about inflation, I want to talk about the new immigration policy, and I want to talk about new mortgage rules by OFSI. So these are all kind of big headline news items, and I want to start with breaking some of it down. Starting with inflation, so February's inflation numbers were in, and it's sat at 2.8%. This is lower than expected. Not quite near the 2%, which is targeted by the Bank of Canada, but definitely, we're now below 3%. Some of the biggest contributors to the lower levels of CPI was groceries and cellular services and internet services. Those have all slowed in growth, but those are more volatile segments of CPI and not something the Bank of Canada will look at for longer term trends. However, the Bank of Canada's preferred measure, core CPI, also came in lower than expected at 3.1%. And we've seen the seasonally adjusted core inflation CPI numbers only rose 0.1% and has only risen about 0.3% over the last 3 months. This is the slowest rate of growth we've seen in CPI since the late 2020s. So we're definitely seeing a stabilization in inflation. However, all that being said, shelter costs did rise to 6.5% last month. A lot of that is the interest cost portion that has been high since the raising of the interest rates, and it makes up about 0.8% of headline CPI. So it's a large contributor to our inflation. And in fact, if you were to take interest costs out of the calculation, it would put our headline CPI at the target rate at 2% for 2 consecutive months. So, however, it is something Canada's never done. They've always looked at mortgage interest cost in their CPI, but most other countries don't do that. The other target we're looking at is the rental rates. Those have gone up 7.9%. So again, still a large contributor to headline CPI at about 0.5%. So these items aren't going to be decreasing anytime soon, and is going to keep inflation sticky for the near future. The second thing I want to jump into is and this really impacts rents, as we were talking about the rent costs, is the new immigration policy. So the federal government came out putting a cap on the number of non-permanent residents coming to Canada. Their target is to take our current 6.2% of the total share of our population of non-permanent residents to bring that share down to 5%. So that would be a potential decline of 440,000 non-permanent residents that are currently reside here over the next 3 years. So it's a major shift and change in our policy around immigration. To put this in perspective, 800,000 new residents came from that non-permanent resident sector, mostly comprised of temporary workers and student visas, but that's about 2/3 of our total population growth. So our population growth was 3.2% last year. The federal government's target is to bring that to about 0.8% by next year. That's a major decline in our population growth. That's something we're going to feel. A lot of this change is coming with the poor poll numbers that the Liberal government's experienced. So they're kind of now, rather than tackle the supply side, they're going to be tackling the demand side. So some of the reasons that are leading to higher rents and higher home prices. Some of the implications of this drastic decline in population growth will be felt on the economic side, as we're already experiencing in Canada a decline of real GDP per capita for 5 consecutive quarters, and labor productivity in Canada has been negative for 11 of the 14 quarters. So we're already experiencing economic slowdown, but really our real GDP numbers have been propped up by our population growth. And once that population growth slows, and it was going to slow naturally as the economy shifted, but now we have a hard cap here and policies in place to really decline the largest segment of our population growth. So really, we typically average about 400 to 500,000 permanent residents, and that 800,000 new non-permanent residents is going to decline. to a point where actually we're going to be people are going to be leaving the country of non-permanent residents. Another major impact of this will be the rental market. So most of those non-permanent residents, the vast majority make up renters. And there's a strong correlation between our rental prices and the percentage of new non-permanent residents coming to Canada. So a major shift in that will impact the number of renters that we have in our market. And this is coming at the same time that we have the record number of condo and purpose-built rentals in our pipeline right now, about 220,000 units to be completed over the next few years. At the same time, we're going to be decreasing 440,000 non-permanent residents from our immigration. So basically, we're having a decline or slowdown in demand, at the same time increase in supply. So we're going to see some major impacts on rental prices in the years to come. The last topic I want to talk about is OFSI's new rules. So they came out and put a cap on the loan to income ratios at 4.5 times the income. This is more of rules put in place for the banks, not specifically directly rules tied to borrow. So this is the kind of the threshold or a percentage or share of the bank's total portfolio of the lenders that they have, or borrowers that they have, how many of them can be, are limited to 4.5 times their income. Currently, new mortgages, we're saying about 12% new mortgages are over that 4.5 times income ratio. It peaked in about 2022 at 26%, but it's down to 12%. And most of these impacts of these rule changes will be felt by first-time home buyers and investors. They haven't quite broken down what the threshold will be for each bank and how they're going to, regulate if they're over, if they have too many of those high risk or high leveraged borrowers. But that'll be broken down kind of in the year to come, because these rules don't take effect until the first quarter of 2025. So next year, first quarter. But we'll likely see them look at HELOCs, like lines of credit, and more credit card debt as well when they're doing these calculations. And so we're likely going to see impact on people who are highly leveraged, people who have multiple properties, or even first-time home buyers trying to get into the market. We'll definitely feel the impact of these rules next year. If you have any more questions and want to talk about this further, feel free to leave a comment or reach out and connect with me. I'm always happy to talk real estate and economics. Take care.